Hello, everybody. I am Garrick Wordmuller, and I'm doing a live event for the first time. So I just want to say this is, very much a test run. If you're out there watching, thanks for tuning in. Kind of cool. I do want to thank Jessica Jones, who is in the back here helping me out. Thank you so much. She kind of turned me on to StreamYard and this whole process. I can't really see comments too well, but we're working on it all. We're working out glitches. So thanks for tuning in. I did invite a lot of people just from different spheres and whatnot. So I know it's a weekend too, and I think I made this a private event. So, again, we're working out kinks. I'm just kind of like getting through doing an online stream for the first time here. But I did want to talk about I'm Garrick Wordmuller. This is my office here, Fresh Home Loan Inc. And today we're going into a few different things with rates, real estate, in the new market. As you know, we've seen a lot of changes in the market. I would say, really, for me, since the end of June, we were rocking and rolling pretty good this year. A little slow start in January, the first couple of weeks, but other than that, it was a really good year. And then we have seen definitely challenges getting offers accepted. Of course, refinances are gone for the most part, things like that. So we're definitely in a new market, and so I want to go into kind of what's there. I'd say this is probably a good presentation for the general public, but then I am going to go into like marketing and things, real estate agents, and loan people in general as well. To kind of this is I work with a blogger who's very good. Jeremiah is a real estate blogger, and he helps me with a lot of data and things. And we've generated this information for you guys as to where the demographics are that'll be buying and selling in the next like 9 to 18 months when we're in this market. We believe. So we're going to talk about mortgage rate dynamics first. Inflation, right? The big buzzword causing a lot of these rates to go up. Of course, with the interest rates, we're also seeing the balance sheet runoff from the Fed's invested 9 trillion or so through the pandemic and mortgage-backed securities, among other things, and that balance sheet is running off, which means there's less mortgage-backed securities to buy. And of course, whenever there's less of something to buy, it becomes more expensive, right? As long as there's a demand for it. So, and then are we in a recession? This is a big buzzword right now. So let's dive in. Immediate effects of the immediate shift in marketing efforts. I haven't seen a market shift this dramatic. Rates have gone up; they basically doubled. But I can tell you, in 20 years, I haven't seen a rate shift this dynamic. So we're looking at rising rates, right? Rising inflation, a lack of inventory, and a lower consumer sentiment. And I can tell you, I have seen like my pre-apps that are moving up. There, a lot of them are just staying in place because rates are high. They have great rates where they are, and so we are seeing a lower consumer sentiment in the marketplace. Just to introduce myself, if you don't know, I'm Garrick Wordmuller. I opened Fresh Home Loan Inc. It's an independent mortgage brokerage here in Alameda. I've been in the business 20 years. We've been open officially since April of last year. So I feel like I'm at a really good place, got my systems in place, and we're out to really help the consumer, help the realtor, do amazing things. But I've been, branch managers for different companies. I've been an in-house lender for both real estate and construction, new construction and condo conversion developments. So I've kind of seen it all, and I have some print attributes. I've been interviewed by Realtor Magazine, National Mortgage Professional Magazine, etc. So been around, here to serve the client and the realtor, just so you know. I do want to give props to MBS Highway and Barry Habib, who assisted with these slides here as well. We're talking about inflation. Let's look at history here and see if we have a pattern for inflation, right? As Mark Twain said, history doesn't repeat itself, but it does tend to rhyme. So in the 70s and 80s, we had Burns and Volcker, and we saw inflation go from 7% to 14%. We saw mortgage rates go from 12 to 18%. So then the feds jumped in. I believe Volcker came in and started raising the federal funds rate, and it was at 11%. He then raised it to 20%. And the inflation response, we went from 14% down to 5% inflation. and mortgage rates went down to 12%, which are crazy numbers considering what we're looking at today. Then in the 2000s, we had Alan Greenspan, right? 1.75% to 3.5% was what happened with inflation. Mortgage rates went to 7%. I went from, 7% to 8.5%. Federal funds rate went from 4.75 to 6.5. Inflation, they raised the federal funds rate again, like they're doing now, and we saw inflation go down, and then we saw rates go down, and each time there was a recession, and then rates went down following that. So we're kind of looking at recessionary patterns here. 1.5 to 8.5% inflation is what we're looking at today. This year we saw rates, in the last, call it 9 months, 2.5 to 5%, call it whatever you want. They're quoting higher in the media. We're anticipating a 3% federal funds rate from zero this year. And the anticipation is that the inflation should drop. And historically, as we'll look, mortgage rates should decline due to these inflationary declines. And so stocks, are kind of tanking. We see signs of a bear market coming. So are we heading to a recession is kind of the next section here. So now I want to show you guys when the Fed hikes rates, contrary to popular opinion and belief, oftentimes rates do go down. So this is in 2016. The Fed's hiked rates, and we actually saw rates go down tremendously. The summer of 2016 was a good time to be in the mortgage business. We did see him spike. This happened with the election, as a matter of fact. It was like boom! All of a sudden, we went from like 3.75 to 4.25 within a few days. So we had then there was a rate hike, and we can see we had little dips go as rate hikes come. You can see rates go up a little; they tend to go down. Then we had a big increase here. This is at the beginning of 2018, and we saw rates in the mid fours, let's say, all through 2018 to the high fours at the end. And then in 2019, these rate hikes started to take hold, and we started seeing really attractive interest rates all through 2019, basically up until this year, right? And then just a quick look. When there is the 10-year note minus the 2-year note is a negative number, it tends to lead to a recession. And so we saw that happen in this slide. It just started happening with us. But in the past, the gray bars are a recession. So there has been like basically 100% of the time we've gone below this, there has been a recession. Also, what happens during recessions, we haven't seen this yet, but unemployment does go up, of course, in a recession, right? People are laying off. I will say, unfortunately, in the mortgage industry, we're definitely starting to see a lot of layoffs. But with stock markets down and everything like that, who knows what will come in the next few months? But that is another trigger of a recession, right? Watching the unemployment rates. But then again, we'll take a look at mortgage rates, and historically, after a recession, they go down basically like 100% of the time, if you notice. So that's kind of what we're looking at. I think personally, like I mentioned, 9 to 18 months of this environment we're in now. I don't know what will happen after that, but signs point to a recession, which could be a good sign for interest rates. So just sharing that opinion and that view with this data that we have for you. Also, notice housing does stay strong through recessions, with the exception of the housing crash, which this recession was caused by, housing and subprime loans and whatnot. So you can take this one with an asterisk, but you can see housing does remain strong through recessionary periods. So good news for that. There's an active market. Another thing, we have less homes on the market. In 2007, there was 3.7. I believe the current number this week is 1.03 million. And we also have more households, right? So we have less houses, more households. Do the math. We've got a housing issue. So that's kind of the look at the market as far as the mortgage rates go. Now, as far as marketing and marketing efforts, Here are some challenges that you're going to be seeing in the future. Lenders, some realtors, especially here, kind of geared for you, but you do have 156,000 new realtors in 20 and 21. So that is a staggering number. So there is a lot of competition out there. Of course, as we've discussed, we have more expensive mortgages and we have less listings out there than we did last year at this time. So, you know, some challenges all the way around. And so, what we were kind of looking at here is where is the business? Identify where your revenue is coming from and where is there is opportunity for expansion. And this will help you continue to be successful in today's dynamic real estate market environment. So, of course, we all know there's first time home buyers, right? No big secret, Garrick. We know there's first time home buyers out there. Well, this is going to be a big market. And I will tell you, having gone through the crash and everything, I do think FHA is going to be a very viable option again. And I think it's sad that it's not always a viable option for home first time home buyers, like in markets like the Bay Area, let's just say anyway, where it's expensive and competitive and there's cash. But first time home buyers are life sensitive, right? Between 28 to 34, I think is kind of when people start really thinking about it. So of course, I'm not giving you any stellar information here telling you that the most of these people are millennials, right? That are buying homes right now. In fact, they're usually 41 years or younger, and it's like almost 80% of the first time home buyer market, with Gen X being a distant second. So huge demographic there. This is kind of interesting though. In San Jose and San Francisco, Lending Tree found that 50% of the mortgage requests were from people between 23 and 38. And you are doing good if you're filling out a loan application at 23. That's impressive. I just want to say. So this demographic is pretty young, right? Of course, but 20, they're in their 20s right now, kind of very active. Looking at buying. So just know that that's out there. Marketing considerations. Millennials use agents. You hear all these statistics, iBuyers, and they just go directly to a Redfin agent that's listing the property, etc. Overall, and that's great if you do. Not this in Redfin, just for the record. But you just hear these stories, I will say, from agents around or whatnot, and media especially. So I'd say 92. So what's interesting is younger millennials, 92% of them use an agent, 88% of older millennials use an agent. So, 90% of these millennials are using agents. Don't let that fool you. Of course, you need to be online over, traditional media such as flyers. So make sure your online presence is strong. Make sure it's, pretty sexy when people log in. It's working and it's advanced. Of course, they're on social media. Data shows they actually report to social media. Only 44% report daily, but they are on there a lot, right? So you need to make sure you have a good campaign on there. And what they're looking for when it comes to buying homes is be educational. And I'll tell you, it seems like the two bigger digital platforms are YouTube and, believe it or not, TikTok, for kind of like blasting education out to the general public. And I just want to share with you, I know an agent on TikTok, or a loan person who does credit repair on TikTok, and she's actually done a really good job, and she gets quite a bit of business just posting about credit repair. So, like, if you're an agent, or even like if I'm to do this too, but just like you could do like a 30-second tip a day, right? Home buyer tip number 537. Did you know you need to show your funds when you write an offer to close? Little things like that that people don't know are valuable tips, and you could just kind of come up with them off the top of the head, right? Like with inspections and deposits and things of that nature. Contingencies. The list goes on and on and on. So they want to understand the process, and 70% said professional assistance during the purchase process was extremely beneficial. And lastly, over half of these people found their agents through a friend, neighbor, or relative. So you think millennials are online, they're just going to, like I mentioned, some of these big real estate platforms, they're just going to find their agent there. These people are working with people that their peers and their family have also known and worked with over 50% of the time. So that's a really huge thing as an agent you should know. Like referrals are important. You need to be, I'd say the best millennial referral right now is from another millennial that you closed, right? So definitely hone in on all that. Make sure you are very effective with your marketing efforts and referral efforts there. Now, a lot of these other ones, can be a little morbid. It is a contracting market, so I don't have any secret subdivisions and buyers to share with you, unfortunately. But I do have some more data on divorce and COVID. So, as a result of the lockdown, right, we know families have been stressed, kids have been stressed, parents have been stressed, husbands and wives have been stressed. So, divorce is on the rise by 34% since before the pandemic. So, as you may or may not know, divorces either have a transfer of title, which is a refi, a cash out refi, or they're going to sell, or they're going to, yeah, sell and buy, right? So, there's a transaction there. It may not be as fun as a first time home buyer, right? But it is a transaction and it's someone who needs your help. So 31% of couples cited lockdown and having caused the most damage. And get this, 20% of people getting divorced right now were married for less than 6 months. And I actually know people who are getting divorced right now. And a lot of them were married like 2, 3, 4 years. And the pandemic did it or different things. But anyway, moving on to effectively capture divorce business. This is a tricky one. I've dealt with these situations a lot. For me, it's a little different. If you're selling the house, the spouses want the most money. It's a pretty easy it's an easier transaction for a realtor. Oftentimes, if I'm cashing out a property, right, the spouse leaving the property wants the most money, and the spouse staying in the property wants to dish out the least amount of money. So a little sticky area. Another thing too is always make sure you're in communication with their respective attorneys. That goes far, and those are huge referral sources for the future. There's no better way to get an attorney, a divorce attorney, I think, than closing a divorce transaction successfully, and you get two usually after that. Mediators too. So data compiling, you can see who's filed for quit claim deeds. Also divorce filings through public records. You can skip trace this information. So this is a good way to get like cold leads, start a letter campaign, things of that nature for divorce leads. Another effective method, of course, I know a lot of realtors who do, have great reputations with local divorce attorneys and mediators. And of course, that's a very solid way to get business. And that people get divorced, whether rates are at 2% or 5% or 10%, right? This is one we all kind of know about too. But the statistics are that we are, with prices going up nearly where 16% from the past year and even higher in some Bay Area cities, I know. Redford found that the activity of users looking to relocate is up 26%, up a third since last year, and up 26% since 2019. So people are still, looking for the exurbia and moving out to the from the Bay Area. It's also very expensive, as we know here, and so that will be a continuing trend. I've helped a lot of clients who sold their home and moved out to like the foothills and different places of California, Sacramento area, and whatnot. So it is a trend that will be continuing. Permanent moves, as we know, have jumped like 15% back in 2020, moving out of large areas. New York, San Francisco, Los Angeles are like the three big ones in the country, right? I think San Francisco at one time like had the most people fleeing and the most amount of depreciation in a big city. I want to say in the summer of 2022. So this is a trend we still will see. It's looking like, and one way to drum up business for this is relocation companies, as well as, a lot of large corporations right now are moving out of the Bay Area. One example, the backpack company that was over here, North Face and Jansport, they just moved out. When they moved out, I had clients, a lot of clients sell their homes, so be on the lookout for that. That's definitely an option, and relocation companies, of course, and just like word on the street, right? People are telling you they want to sell and move. Number four, baby boomers are still a huge. This is actually the hugest demographic of people selling houses right now. So these are people from ages 57 to 75 that are at or nearing the retirement age. And these make up 42% of all sellers. So basically it's like half of the market essentially, right? And reasons, of course, empty nesters, maintenance, I'm sorry, fixed budget. So this is a good demographic, possibly two transactions for you, right? A purchase and a sale. Marketing considerations. So the highest group of home ownership in America right now are people aged 65 and over. That's the highest home ownership percentage we have. Now, most of these homeowners have probably owned homes before, so here's some competition and some things we need to consider. I'm checking on some stuff real quick here just to make sure I don't got people talking to me or whatever. Bear with me. All right, we're cool. Um, all right, so competition. Most of these homeowners have probably owned homes before, right? They've done multiple transactions, right? They know realtors, right? So we do know, this is a demographic that is familiar with the sales process. Um, Good referral partners. I know this personally, with senior citizen clients. Financial advisors are just amazing. Retirement specialists and even reverse mortgage lenders are a good source for people possibly looking to downsize. And then know this too, as far as marketing, direct mail and AM radio, I mean, that's kind of old school and has been around, and it's still working and fruitful according to statistics. But I will tell you, all my aunts and uncles that are baby boomers, I mean, they are on Facebook all the time. So Facebook is a viable place to put together some sort of ad campaign for your baby boomers. So keep that in mind. And then the last thing I'm going to leave with is trust and probate deals. This is when someone inherits a property from someone who's passed away. Um, so basically, probate transfers the assets of their heirs, but because they live, in for whatever reason, a lot of times people inherit a house and want to sell it, right? They want money. This is usually very motivated sellers. Is a good situation, but you can run into sticky situations with families and desires for the property. And I just want to throw out there, I know a lot of realtors who do a lot of trusts and probate transactions and have some great relationships with probate attorneys. And we work with a lot of them too. And I will tell you, as far as loans go, a lot of these people like you want to make sure we know what we're doing when it comes to trust and probate deals. A lot of people will call them a cash out refi. For example, I closed a deal in November, right, 6 months ago, where a father and a daughter were going off of title, and the son was staying on, and all these lenders called it a cash out refi. I'm not. It's a transfer of title. It's not a cash out refi. You can't. This is not the way it works, etc. And even where we submitted the loan got denied, but we ultimately funded the loan, and I knew it was going to fund. I was very confident anyway. I was very confident it was going to fund, and if he had to wait 6 months, it would have been right now, and literally his interest rate would have been like almost. It would have been at least 2% higher, right? And his payment would have been like 40% higher if he followed the directions of these larger, you know, nondescript lenders that he was talking to that they just didn't have any idea how to structure the deal. So I'm just going to throw out there, you got these and they want to keep the house. We need to handle that transaction so your client's being taken care of. This is a kind of morbid. I will say Jeremiah pulled this information for me, but obituaries are a good start to. It's a it's a morbid way to get probate leads. Of course, like I mentioned, probate attorneys are a phenomenal way. Go to Yelp and see who's in like the surrounding three cities, right? And write letters and call and shake hands and all that good stuff. Court records, another good way. You can see who's filing probate processes. And then, like I say, direct mail seems to be, still a viable solution, of an easy, inexpensive, and somewhat viable solution for marketing in a lot of these areas when you can skip trace these leads, like with divorce, with probate. Um, so those are marketing considerations. So again, this is a lot of where listings and buyers are coming from in this market. And you've heard of all these before, I know, but now you know the actual statistics of them and the kind of activity that we're going to see in the next coming months. So that's basically what I have for today. But I did want to let as far as Fresh Home Loan is concerned and Garrick Wordmuller, I am here to take care of the client, the realtor. I'm very well. The number one thing you need from a lender is speed, right? Same day pre-approval submission. We order the day your offer is accepted, it's submitted, it's disclosed, appraisal's ordered, no questions asked, it's done. So don't worry about it, unless it's like at 9 o'clock at night. But speed is of the essence. I know that we write deals at 21 and less as well, and they fund on time. So another thing is we can shop rates the same day that your deals are accepted, and that's very important because I happen to know, like when I worked at a retail bank, if we were busy, our rates were higher than the market, and this is why I started Fresh Home Loans. I don't have to deal with that anymore. But if you're working in rates, like they have a spigot and they'll slow it down. So if you're with a retail, one of the big retail banks, and their rates aren't very good that day, well, then that's the day you lock, and it's too bad. And if they go down, there's nothing you can do about it. We have recourses. We also have the ability to transfer an appraisal if we need to. Something funky came up on a loan, appraisal's in, we're ready to close, no problem. We can transfer an appraisal and probably turn around a deal in like 48 hours. We don't like to do that. We don't usually need to do that, but we can do that. Ability to move the loan and get a new appraisal. Also, if it doesn't happen very often, but I've seen it happen where the clients and the realtors aren't happy with the appraisal, or even I haven't been. I've been able to move it, and one time I got like a $60,000 increase on an appraisal because we had a bad appraiser. We do have lower rates typically than retail, like heads and tails lower, usually like a quarter to a half. I can tell you, just on quote yesterday, I was at like 4.69 roughly when they were paying over a little bit of a point. And I'm not quoting an APR here, just kind of a loose quote. But when you see on CNBC or Mortgage News Daily or whatever, you're at five and a quarter, you might want to call me. We can shop turn times as well the day of acceptance. Now, right now, everyone wants to close your loan in 4 hours. Trust me. But in the summer of 2020, some people were taking 45 days just to underwrite a purchase, which is ridiculous. So when we had other lenders that were doing, 3 to 4 days, and sometimes it'd go down to 48, and sometimes it'd be same day. We always focus on that. And I think brokers have a really big advantage in the marketplace to getting loans approved in less than a day or a day right now and in general. But we can shop those turn times so you're not stuck on a 21-day close with a 45-day underwrite. More products, reverse mortgage, bank statement loans, home equity lines of credit have been real big lately. Those can work as bridge loans as well as kitchen remodels and anything else you need. And then we do have lower conventional mortgage insurance. So I do want to share this with you that I was like $150. I had a client, a realtor sent me a buyer, and we had them all pre approved. And then they switched realtors. And of course, that realtor wanted them to go with their lender. And I was like $150 cheaper on mortgage insurance. I was way lower on rate too, but I was $150 cheaper just on the mortgage insurance on that. So know that there are just way more benefits to using an independent mortgage broker, even if it's not me. But if you're in California, you know what to do, right? So thank you so much. I'm Garrick Wordmuller. This is a total like test run on a holiday Friday, and I hope you're watching and you enjoyed it. And thanks for questions, comments, and everything like that. And I am going to end the broadcast now. I'll see if I have any comments.